Recent tariff actions by U.S. President Donald Trump have triggered significant volatility across global financial markets. The sharp rise in trade barriers has unsettled investors and cast fresh doubt and uncertainty over the economic outlook. In a recent article and accompanying audiocast, Morgan Stanley's Global Investment Committee outlined three critical implications for investors navigating the current environment. These include a downturn in economic forecasts, increased risks to corporate profitability, and a lack of clearly defined policy objectives, which continue to obscure the broader market direction. Commenting on the developments, licensed stockbroker and investment management specialist based in Jamaica, Ryan Strawn, advised investors to proceed with caution. He warns against buying shares at high prices right now, advising instead to stay patient and wait for more stable conditions before making any major moves.
I think it goes a lot further than tariffs in and of themselves and what that means for the global economy. Rather than we'll have to assume that this is an investor coming to the market or already has a position in the market. Now, there may be somebody who has been buying equities faithfully for the last 10, 15 years and is holding on to a tremendous amount of profit and is wondering, do they sell now? What would they do in this time of tariffs? In my view, if I were a seller, if I were somebody holding equities in a profitable position, I would be holding in anticipation of deals being struck with the major trading partners globally.
Investment management specialist based in Jamaica, Ryan Strawn. He added that as a buyer, he would be actively considering two things. First, what will the economy look like in a post-tariff settlement environment? Will production bases shift, or will the fortunes shift as well? Secondly, Mr. Strawn says investors should ask the political sides of settlement as far as it concerns production and business activity. They should also consider what industries will be banned as a result. Meanwhile, Chief Investment Officer and Head of the Global Investment Office at Morgan Stanley Wealth Management, Lisa Chalet, is also advising investors to remain measured in their approach. She cautions against knee-jerk reactions to market swings.
So for now, we're taking a wait-and-see approach. Avoid knee-jerk panic. Instead, consider adding excess reserves to short-term fixed income and withholding rebalancing flows to global equities other than to Japan, which may benefit from inflows to the defensive yen. Also, now may be a good time to add to private investments and real assets.
She has this advice for long-term investors, especially those of the S&P 500.
The technicals right now are not pretty, but long-term investors should see 5,100 to 5,500 as defensible entry zone, although equal weighting to the index is still preferred. Overall, our advice remains be patient, be vigilant, and stay diversified.
Chief Investment Officer at Morgan Stanley Wealth Management, Lisa Chalet.